What's up, everybody? Welcome to the September 8th, 2025 IndiView Weekly Market Update. I'm Jeremy Bryan, and this is powered by IndiWell. So today we're just going to get right into it because we've got some interesting stuff and a little bit of a dichotomy to talk about with regard to some of the negative and the cracks that we're seeing in the economy versus what's happening with the S&P 500 companies. So let's get right into it. First thing, I think it's time to start being concerned about jobs. I've said on here many times, 1 point does not make a trend, but we've had 2 points, and there's some other data that's showing some real cracks in the job market. Again, we're not in massive amounts of layoffs and really aggressive concern territory, but certainly some yellow flags. And we'll start with just the jobs number in and of itself. So you kind of have to take unemployment rate and job growth as two things in one a little bit. Because if you're looking at just the unemployment rate number, it's rising, but rising very shortly. It's up to 4.3%, which is not, it's below long-term averages. So just the unemployment rate number would suggest we're still in a relatively healthy job market. The real problem comes on the second side, which is the job growth number. And we've had 2 really lackluster growth numbers the last couple of months here in July and August reports. Enough now that I am concerned that we may go into contraction territory, or we just may be in a very slow period of job growth. Which again, if you've heard me talk, you've heard me say it a million times, is that I think jobs is one of the most critical components of the U.S. economy, because not only of the job being allowing you to pay your bills and all that fun stuff, but the sentiment around jobs really propels our spending, and our spending is what our economy is made up of. So I get concerned when I start to see numbers like this, because people will start to, and I talked about this in my monthly report a little bit, is we're transitioning from job velocity to really kind of job holding, right? Is now the sentiment has shifted probably over the last 6 months in saying, boy, it used to be, a couple of years ago, I could just go get another job and I'd get a big raise. And, and then another firm would be looking for my skills too. So I could continue on that path upward, or my current company has to pay me more to stay. Now it's a sentiment of, I don't know what's going on out there, so I'm just going to really hold on to what I have right now. And again, that's not horrendous, right? You still have a job, but it doesn't lead you to saying that you want to be aggressive with regard to how you're going to spend your money going forward and increasing that spend because you can get a couple of raises coming through. I think we're out of that area right now. It does seem to be the case, because the other piece of information that I pay a lot of attention to is what's called JOLTS, which is just job openings. And really what you want to look for there is the trend of openings to number of people accepting or looking for work. So before, especially in late 2021, we had significantly more job openings than we had people to look for that. That's why you saw that you could move on, and the job velocity and the growth in wages was going up too. Inflation, this exacerbated inflation to a certain extent, but really healthy job market, and honestly, probably an overheated one. We've come down from that perspective into a slower number and a more equal number of people looking for work to job openings. Well, this most recent report, we've gone into the other territory where there's now less job openings than there are people looking for that. And that's an area where if we stay there or bring it down even further, that can really weaken sentiment fast, because if it's taking people longer to find a new job, if they lose their other one, or if they're, again, doing the job holding, even under an area where they're not getting aggressive wage growth or any raises at all, those are the kinds of things that can have a sentiment impact that lead on to further weakness down the road. So that's where I'm saying that, from the cracks perspective, from the things we're starting to see that are showing a few cracks, I think that's the one I'm probably most concerned about. And I think it's time to be concerned about the job market. The other one is inflation. And inflation, I just want to say that we're not under control yet. We've kind of forgotten about it, right? Is that now the Fed expectations, the Federal Reserve is now expected to go from one cut and monitor. Because of the weak jobs reports, now we're starting to see the market have expectations of the Fed is going to cut, right? Is we're going to have several cuts in a row because the job market is weak. Definitely a possibility, no question, but I would I would tap on the brakes here a little bit with regard to just saying that's going to happen, because the expectation of economists for this month's job or inflation report is for a slight tick up to 2.9% year over year growth. Yeah, again, that means 2.9% is not 5, 6, 7, 8, 9, what we were getting before, right? Ridiculously high prices and all that. But the frank part is that the target is 2 to 2.5%. We're still above that, and we're ticking the other way. We're going upward, not downward. Now, again, this is the expectation. We haven't seen the actual number yet. The actual number may be very different from the expectation. We'll see. But what I just wanted to be clear on is that the Fed has two mandates. They have they want a good job market, and they want controlled inflation. If we start to see, even if the cracks in the job market happen and inflation is accelerating upward, that's a difficult spot for the Fed to be in. It's probably one of the most difficult spots for them to be in, because how do you support an economy? You lower rates, and then inflation can tend to rise as a result of that, because you have more money out there to spend on things, right? It's cheaper money. And I get it from an economic support side, but that does not help with getting inflation under control. So we could be in a little bit of a sticky spot here. Again, we could, the CPI number may come out this week and it may be much better than I expect. But we have to be cognizant that the Fed has to get both of those things figured out. And I just think, from my perspective, those are both cracks in the economy. Again, is this a sell everything, our hair is on fire? Absolutely not. But this is a different market and a different thought than we were having 6, 9 months ago, where we had really robust job growth still at this point, and inflation was working its way down. We're in a different story now, and the effective jobs are working their way down. The job growth numbers continue to work their way down, which is not good. And inflation has been steady and potentially slightly rising here. We'll see how this goes, but those are the things that I'm a little more concerned by, certainly, than I was 6 months ago. Now, I told you it was kind of a push and pull here, because one of the things that, if you've been watching the stock market at all, is we're near all-time highs. We're right near there. Again, it's been a really strong stock market overall. And the reason for that, in my opinion, is that, again, for longer periods of time, and really the sentiment around the stock market and when you can drive valuations higher, is when you have earnings rising, right? When you have good growth that's expected to continue to grow and actually going up from those expectations. And the biggest surprise to me, to be honest with you, is I had called earlier in the year and said, we're likely to have lower than expected growth than when we started in January. And to be honest with you, it was pretty linear downward. That call was fairly right during from a January to July perspective. Well, now since July, I think 15th is we're right around the bottom, 15th, 30th, somewhere around that territory. We saw a bottoming of the earnings estimates for 2025 and 2026 in the S&P 500. And now they're starting to work their way back up. Companies are giving positive guidance. They're actually guiding. They're saying, hey, here's what the tariffs number are, but we're doing okay. We're looking through it, and our growth is still doing well. So there's been positive guidance out there, which has led that number to start rising again. And I think that's really held up the S&P 500. More than anything else is that we're saying, hey, it's 500 companies. These 500 companies in aggregate, the number is actually starting to rise up again. That's a good backdrop if that can continue. I do worry, since we're at basically all-time high profit margins. Now, again, that happens and it could continue to go higher. Absolutely. But from the perspective of just we're at all-time high margins with uncertainty on costs from tariffs and trade deals and all that other fun stuff. But the companies at this point right now have not suggested that margins need to come down aggressively. Sales are coming down. We haven't heard, there's been more news of job layoffs, but it hasn't been, there hasn't been an aggressive number of that coming through. So the companies at least are telling a little different story than that cracks, that I was talking about before, is that companies have generally been holding up relatively well. And if that continues, now again, you can't really over longer periods of time have a terrible economy and great companies, right? It doesn't work that over a longer period. Those tend to work together. But in these little periods right now, this can absolutely happen from time to time. So we just got to continue to pay attention to what the data is telling us and see where those trends are going. But this is what I said in my monthly outlook, is just it's probably time to think, if you have not rebalanced yet this year, you've had a very strong market, especially if you own gold and international stocks, to taking a little bit risk off the table and maybe even going a little further than your equilibrium risk, right? So let's say you're a 60% stock, 40% bond portfolio, right? Well, taking it down to 55% in stocks and 45% into bonds to give yourself a little bit more safety, a little bit more margin of safety, is okay right now. That's not the worst case scenario. What I'm not saying is you're not going to go to zero and you're not going to go, I'm going to sell everything until all clear is out there, until I know what the situation is. You're never going to know perfectly. But right now is probably a better time to be holding risk or taking risk back down a little bit rather than chasing it excessively. That's our stance at this period. Now, turning to the last one is on the personal side, football season's back. We had week 1 of football. It was fun. I think if you saw last night's game between the Bills and Ravens, I don't have a fan. I'm a Vikings fan, so I didn't have a dog in that fight. I just wanted to watch a good football game, and it absolutely was. It was a very, very good football game last night against 2 of the best teams in the league. So it was a very fun game. And for you stat nerds out there, it ended at 41-40, which is what they call a scorigami, which means it had never happened in the NFL before. So little stat nerd thing for you there to a really good game, but I'm just happy that football's back. I think August was a little slow from a sports perspective, but now we're kicking back in with football, and I can't wait to get it going again. So I hope you found that informative. I hope you found it helpful. Thank you very much for tuning in, and tune in next week where we'll have our next hot button topic. Until then, thank you and take care.